Do you believe you'll be paying more or less in tax when you retire? Most people falsely believe they'll be paying less in tax in retirement. Now that's understandable because they're no longer earning a paycheck. But unfortunately, that won't be the case for many hardworking Americans. Now in reality, you could be paying even more in tax in retirement due to having to withdraw money from your IRA and 401k, taxes on your Social Security benefits, taxes on your investment income, and more. And as a result, your retirement savings that you spent your lifetime to save could be a fraction of what they are today. My name is Chris Abts from Cornerstone Wealth Management, and welcome to Redefining Retirement. Today, we're asking an important question, which is, how do you take income from your investments during retirement in a tax-efficient manner? Every day, people come into our office, and in listening to them, we find they don't have a strategy on how they will take income from their investments tax efficiently. Now, I want you to be honest with yourself. Is somebody helping you to be tax smart when it comes to coordinating your various assets and income sources to ensure that you will pay the least amount in tax? In my experience, the answer is no. So today, we're asking the question, how do you take income from your investments in a tax-efficient manner? Today's show, it's the first step to prevent your hard-earned retirement savings from being needlessly wiped out by taxes. Here's what's coming up. So as a result, this option, it does not create any tax efficiency, but rather just the opposite. It actually increases their tax liability. During their early retirement years, their taxable account, it's allowed to grow and compound, but it will not grow as fast due to the annual taxation on interest, dividends, and capital gains. So as a result, this strategy will provide them with the greatest wealth, which increases the length of time that their portfolio can sustain withdrawals. I'm really excited about today's topic. Sit back and relax. Redefining Retirement starts right here, right now. Saving for retirement is a great start, but it's what you do with your money that matters. So how will you generate your income? Minimize your risk, maximize your Social Security, and reduce your taxes. Welcome to Redefining Retirement. I'm Chris Abts, and this is where you can count on straightforward and objective advice on the toughest challenges you'll face in retirement. So let's jump into today's topic, where we're asking the question, how do you take income from your investments in retirement in a tax-efficient manner? You spent your entire life saving and investing to achieve financial security. Now maybe you're there, maybe you're still working toward it. Regardless, what is your plan to coordinate your various assets and income sources during retirement so that you pay less or the least amount of tax? Now in my experience, you probably don't have a plan. So that's what we're going to learn about today. So let's begin by introducing you to a really nice couple. Let's change their names to Paul and Lynette. Now they've been watching this show for some years now, and they came in to meet with us. They're about 60 years of age. They just retired. They have about $1.5 million in investments. Now I had the opportunity to meet with them, and while their concerns centered around things like, the risks they were taking, their returns, the fees they were paying, creating an income plan, one concern they had really struck a chord with me. You see, they had been with their current advisor for about 25 years. When I asked them to share with me the analysis that their current advisor had done for them to help them to establish a tax-efficient distribution plan from their investments and what their plan looked like, they said, we don't have one. That's one of the reasons why we're here. So in other words, their current advisor helped them to put together a bunch of investments, but there was no plan on how they were going to take income from those accounts in a tax advantageous manner. You see, they have some pension income, they have their Social Security, and they will take income or distributions from their investments, and there was no plan or no recommendation on how they were going to take this income tax efficiently during their retirement years. So Paul and Lynette, they have about $750,000 in an after-tax investment account and about $750,000 in an IRA. So they've got a total of $1.5 million. Now, let's assume they're going to average a 7% rate of return, and they're going to take $80,000 a year from their investments. So the first option we're going to look at is what would happen if they take income from their IRA first, and then after the IRA is spent down, then take income from their after-tax investment account. So their first option is to take full distributions from the IRA during the early stages of retirement, and here it is. As you can see, the IRA gets spent down in about 10 years. So after about 10 years, they switch and they begin taking income from their taxable account. So 30 years into retirement and their money, it's pretty much depleted. Now from a tax perspective, they force themselves into tax brackets that are higher than necessary. During their early retirement years, their taxable account, it's allowed to grow and compound, but it will not grow as fast due to the annual taxation on interest, dividends, and capital gains. So obviously, this strategy won't help them to take distributions from their investments in a tax-efficient manner. Now, over the past couple years, there have been many things that we've been able to control, but this area, taking back control of the taxes you'll pay during your retirement, this is an area where you can take back control, which can give you more confidence in retirement. So here's the bottom line. Taxes will likely be your biggest expense in retirement, and you may be massively underestimating the taxes that you'll end up paying over this life phase. But right now, there are strategies that you just might be able to take advantage of to dramatically reduce those taxes with a free Cornerstone Retirement Tax Savings Analysis. Here's how it works. First, we'll get some basic information from you. We'll determine the tax saving strategies best suited for your specific situation. Then we'll sit down and we'll share these strategies with you so that you can see exactly how much money you could save in retirement. Now, these strategies, they can save you tens of thousands, if not hundreds of thousands of dollars. So, if you've saved at least $250,000 for retirement, give us a call to schedule your free analysis. And coming up next, we're going to take a look at the second tax strategy this couple can use, and that is doing just the opposite. So we'll see what it looks like if we take income from the taxable account first and defer IRA distributions until later. Which do you think will be better? The answer when we return.
At Cornerstone, we believe you should be able to enjoy the retirement you have always wanted. To help you see your retirement strategy from all angles, we created a retirement roadmap, which is designed to help you discover the knowledge you need to take control of your money and live a confident retirement regardless of what challenges arise. So you envision the life you want to live, and we can help you create a plan that leads you down that path. Join us for a conversation about your vision for your ideal retirement by calling the trusted professionals at Cornerstone.
Approaching retirement requires a shift in how you view your investment and income portfolio. Are you making the transition successfully? Author Chris Abts, in his latest book, Maximizing Your Income, will show you how to structure your income while avoiding 10 retirement pitfalls. You'll also learn 3 strategies to create sustainable retirement income. Learn to plan for potential healthcare costs and how to avoid 4 common yet costly Social Security mistakes. The information you gain from this book may help you retire sooner and help you stay retired. Get your complimentary copy today at MaximizingYourIncome.com and take control of your retirement.
Could your tax bill in retirement be larger than you think? Taxes can play a significant role in retirement. After all, they determine how much of your hard-earned savings you get to keep and how much you send to the IRS. If you're like many savers, you may not know the total amount of taxes you could potentially pay. I believe information is critical to making informed decisions about retirement. If you agree, I want to share a resource that can help. Use your phone camera to scan this QR code. It will take you to a page that generates a quick report that can help evaluate your potential tax bill in retirement.
If you'd like more information about financial planning, industry news, and market updates, you can subscribe to our blog. Visit our website at cornerstoneway.com. The resource request box is located on the bottom right-hand corner of the homepage. There you can submit your information to subscribe to our blog.
Behind every photograph is a story. How will your life story be told?
We got the house of our dreams. Thank you for the down payment, Mom and Dad. It helps so much.
20 years ago, I remember hugging you just like this, Dad. Thank you for teaching me strength.
Say hello to Emma. Mom, you gained the title Grandma and a new best friend. She has your eyes, and I know she'll have your heart.
Create a legacy, a story worth telling. To learn how, call 853-9033.
Welcome back to Redefining Retirement, where you can count on straightforward and objective advice on how you can maximize every dollar that you've saved for retirement. Taxes will likely be your biggest expense in retirement. So today, we're asking the question, how do you take your income from your investments in a tax-efficient manner during your retirement? Now, to answer that question, I introduce you to a nice couple that came into our office. We call them Paul and Lynette. They're 60 years of age, $1.5 million investments, and they just retired. And they came in to see us and shared that they want to properly position their assets for their retirement. Now, one of the concerns they raise is that their current advisor has not helped them to create a plan to take income from their investments in a tax-efficient manner. Now, before the break, I shared with you the first option that we looked at with Paul and Lynette. And that was to take full distributions from their IRA account during their early years of their retirement and then spend the taxable account later. And we learned this option leads to higher taxes because they give it the benefit of tax-deferred compound growth in the IRA. So they risk running out of money in their later years. So let's now take a look at their second option, which is doing just the opposite. So let's see what happens if Paul and Lynette, let's see if they do the opposite and instead take income from their taxable account now and take full distributions from their IRA during their later years. Now, in this scenario, the IRA would have more time to grow and compound on a tax-deferred basis. And as you can see, by spending their taxable account first and taking full distributions from their IRA during their later years, the taxable account is spent down over the first 13 years of retirement. Yet due to the IRA funds growing and compounding on a tax-deferred basis, their portfolio, it's able to handle distributions over a longer period of time, thereby reducing their chance of running out of money. Yet while this option does allow for more wealth to be created, it actually increases the amount of tax that they will pay. So doing it this way will force them into higher tax brackets during their mid to late retirement years. And this is because the withdrawals coming from their IRA will be significant in their mid to late retirement years. So as a result, this option, it does not create any tax efficiency, but rather just the opposite. It actually increases their tax liability. And we find that from a tax perspective, the first option we looked at, which was taking full distributions from their IRA at the beginning of their retirement, that will force Paul and Lynette into higher than necessary tax brackets. The second option, again, is to take full distributions from their IRA during their later years, which will move them into higher tax brackets during their mid to later retirement years. So let's now take a look at their third option, and that is liquidating both accounts simultaneously. So let's see what happens if Paul and Lynette, if they take income from their taxable account as well as their IRA account at the same time. So from a tax perspective, this is more tax efficient. This strategy allows them to remain in the 12% tax bracket all the way through their retirement years without ever really moving up into the 22% tax bracket. Now, in addition, by taking this blended approach, their portfolio, it will last much longer than the other two options. This is because a larger portion of their IRA will continue to benefit from tax-deferred growth over many more years, and also because their taxable income will continue to remain and never exceed the 12% income tax bracket. But the second option, and again, that was to defer taking those full distributions from their IRA until the mid to late retirement years, that actually result in creating more wealth by the end of 30 years of their retirement. This is because the IRA would still have a significant amount of money that's not been taxed yet. So that's obviously a major future tax liability problem. But the fact is it results in greater wealth. That's misleading. So here's why. Option number 3, which has a lower ending account balance, when you take the time to factor in the tax liability, option 3, it's still the better choice because the majority of their money would now be considered after-tax money. So not only is the third strategy more tax efficient during their retirement years, the ending account balance will have a lower tax liability for their heirs. Now, in addition, this strategy, due to the additional wealth created, it will sustain withdrawals over a longer period of time. So as a quick recap, option 1, that's taking full IRA distributions during early stages of retirement, that forces them into higher than necessary tax brackets. So that's clearly not tax efficient. Their second option, take full distributions from their IRA during their mid to later retirement years, that also forces them into higher than necessary tax brackets. So it's also not tax efficient. And then option number 3, that's taking partial IRA distributions over all their retirement years, that results in much greater tax efficiency by keeping them in the lower 12% tax bracket. So far, option 3 is clearly a better strategy as it keeps them in lower tax brackets throughout retirement. But wait, we're not done, because there's a 4th option. So far, we've looked at 3 different strategies that lead to wildly different tax situations in retirement. But this couple, they had no idea. Nobody had shared this important piece of information with them. So don't make the same mistake they made by not having a plan to tax efficiently take income from your investments in your retirement. I want you to imagine being 73 years of age and learning that your hard-earned retirement savings not only can be subject to a 50% late distribution penalty, but you could end up paying far more in taxes than you need to simply because you didn't have a strategy with your IRA or 401k. So this is where we come in. One of the things that we're really good at is helping people minimize their taxes in retirement. Today, there are many strategies we can use, but this is not a do it once and forget it. Your tax planning strategies and savings, they should be revisited annually. So this is one of the areas where we've been able to help so many families. So here's what I recommend when it comes to navigating your taxes in retirement. Don't wait until you're 70, 72 years of age to address this. Get out in front of your RMDs way before you retire. Ideally, maybe between the ages of 55 and 60. This problem isn't going to go away, it's only going to get worse. And the sooner you address it, the more options you'll have that could save you a very large amount in tax. And that's why we put something together for you. I want you to learn how you could dramatically reduce your taxes in retirement with our free, customized Cornerstone Retirement Tax Savings Analysis. So here's how this works. First, we get some basic information from you. We'll determine the retirement savings strategies best suited for your situation. Then we'll sit down and share these strategies with you so that you can see exactly how much you could save in retirement. The savings could be tens of thousands, if not hundreds of thousands of dollars. So if you've saved at least $250,000 for retirement, give us a call to schedule your free analysis. And when we come back, I'll share another strategy with you that's even more tax efficient. We'll be right back. Could your tax bill in retirement be larger than you think? Taxes can play a significant role in retirement. After all, they determine how much of your hard-earned savings you get to keep and how much you send to the IRS. If you're like many savers, you may not know the total amount of taxes you could potentially pay. I believe information is critical to making informed decisions about retirement. If you agree, I want to share a resource that can help. Use your phone camera to scan this QR code. It will take you to a page that generates a quick report that can help evaluate your potential tax bill in retirement.
When you have confidence in your retirement future, you can live the life you've always imagined. Because of planning, you now have time to reflect on the wonderful memories of your life. Spend fun times with your grandkids, sharing the joy of their excitement about life. At last, you have time to breathe and rekindle the love of your life. Why? Because you imagined what could be. You planned for retirement. So today, you own your future.
For trustworthy fiduciary-based guidance, call 775-853-9033.
At Cornerstone, we believe you should be able to enjoy the retirement you have always wanted. To help you see your retirement strategy from all angles, we created a retirement roadmap, which is designed to help you discover the knowledge you need to take control of your money and live a confident retirement regardless of what challenges arise. So you envision the life you want to live, and we can help you create a plan that leads you down that path. Join us for a conversation about your vision for your ideal retirement by calling the trusted professionals at Cornerstone.
Stay informed on the latest news and events affecting retirees at cornerstoneway.com.
Want to learn how you can make your money go a lot further in retirement? You've come to the right place. Welcome back to Redefining Retirement. I'm your host, Chris Abts from Cornerstone Wealth Management, and taxes will likely be your biggest expense in retirement. So today, we are asking the question, how do you take income from your investments in a tax-efficient manner? We're answering the question by sharing the story of a couple that I met with, and we changed their names to Paul and Lynette. So far, we have looked at 3 options. The first is for Paul and Lynette to take full distributions from their IRA at the beginning stages of their retirement. The problem with this strategy is that it forces them into higher than necessary tax brackets. The second option we looked at, it was just the opposite. They could take full distributions from their IRA during their mid to later retirement years. So think of this option as following the IRS's rule of starting your RMDs when you're required to do that. Now, the disadvantage here is that it again forces Paul and Lynette into higher than necessary tax brackets. So the third option we looked at is for them to take partial distributions from their IRA over all their retirement years, beginning the first year of retirement all the way through to the last year. Now, this strategy, it actually provides solid tax efficiency and that they remain in lower tax brackets throughout all their retirement years, and their portfolio, it can sustain withdrawals over a longer time frame, thereby increasing their financial security. So the strategy of taking partial distributions from their IRA over all of their retirement years, it actually extends the number of years that the portfolio can sustain withdrawals, simply due to keeping them in a lower tax bracket. But the tax advantageous benefit of tax-deferred compound growth, it's reduced prematurely. So in other words, one of the benefits of an IRA is tax deferral, and this strategy prematurely reduces this benefit. And before the break, I told you there was another option, one that is typically an even better way. So this is the fourth option, and for many of you, this is likely the right way to do it. I call this partial Roth conversions, but it's probably not what you think, so allow me to explain. The strategy is to take simultaneous partial distributions from both your taxable account as well as the tax-deferred IRA, just like option number 3. But here's where the final strategy differs. If you recall, for Paul and Lynette, the goal is to take enough distributions from the IRA each year until they reach the top of the 12% tax bracket. So these IRA distributions, those are then used to make partial Roth conversions each year. Now, using this strategy, their taxable account will still be depleted during the first half of their retirement, but they continue to remain in the 12% tax bracket throughout all of their retirement years. Here's why. Once the taxable account is depleted, they will then take partial distributions from their IRA and partial distributions from their Roth for the rest of their retirement years. Now, the advantage to using this option is that not only will they remain in the 12% tax bracket throughout all of their retirement years, but they will also continue to benefit from the tax-deferred compounding growth of their IRA and the tax-free compounding growth of the Roth. So as a result, this strategy will provide them with the greatest wealth, which increases the length of time that their portfolio can sustain withdrawals. Now, for our example couple here, Paul and Lynette, the key is not to convert their entire IRA over to a Roth. Very important. Instead, they will simply convert enough each year so that they still remain in that 12% tax bracket. And when executed properly, this strategy will provide them with the greatest amount of wealth, the greatest chance of not running out of money, and the least amount of tax. Pretty cool. So as a quick recap, we asked the question, how do you take income from your investments in a tax-efficient manner? To answer that, I introduced you to Paul and Lynette, and we looked at 4 options. We looked at the advantages and disadvantages of taking full distributions from their IRA during their early stages of retirement. We looked at the advantages and disadvantages of taking full distributions from their IRA during their mid to later years of retirement, which you might refer to as RMDs. We also looked at the advantages and disadvantages of taking partial distributions from their IRA during all of their retirement years. And then we looked at the advantages and disadvantages of making partial Roth conversions during the early stages of their retirement. And we found that for Paul and Lynette, for them to take income from their investments during retirement tax efficiently, the best strategy for them is to make partial distributions from their IRA during the early stages of retirement while staying within the 12% tax bracket. So not only was this their best option and that it resulted in keeping them in the lowest tax bracket of their retirement years, but it also provided for the greatest financial security because it allowed for the most wealth creation and the longest period of sustainable withdrawals. So a few key points here is it's not necessary to convert the entire IRA to a Roth. Also, if the IRA is not needed for income at all, Not doing partial Roth conversions during the early stages of retirement can actually create less wealth in the long run. So simply put, partial Roth conversions, they help to reduce the tax liability because it ensures that distributions happen at more favorable tax rates. So bottom line, if you want to take income from your portfolio in a tax-efficient manner, you must find and use the right strategies. But if you take too much from the IRA, you will likely pay more than necessary in tax. And if you convert too little, you will again likely find yourself back in higher than necessary tax brackets. So the key is to find the right balance between these 2 points. You see, just like the balancer Paul and Lynette, how it was dependent on their income and their wealth levels, your balance point, it's also based on your overall income and wealth levels. So here's an example. You may want to simply stay in the 12% tax bracket, or if you have a large retirement account balance, your goal may be to stay in the 22 to 24% tax bracket, or perhaps you have significant wealth and perhaps just staying out of the 37% tax bracket may be appealing for you. So regardless of where you fit in the spectrum, the goal is still the same. Take income from your investments in a tax-efficient manner. So how about you? What's your plan to take income from your investments tax efficiently? As I always say, achieving financial freedom, it's all about making smart choices. And making smart financial decisions begins by learning the questions to ask and the problems to solve. So here's the bottom line. There could be strong headwinds ahead for all investors. So trying to grow your nest egg in this environment today, it could come with even more risk. And most people don't think about this, but the fastest and safest way you can grow your nest egg right now is by reducing your taxes in retirement. See, the less money you have to pay to the IRS, the more money you get to spend when you're retired. And that's why we put something together for you. I want you to learn how you could significantly reduce your taxes in retirement with our free, customized Cornerstone Retirement Tax Savings Analysis. Here's how this works. First, we get some basic information from you. Then we determine the tax saving strategies best suited for your specific situation. Then we sit down and share these strategies with you so that you can see exactly how much money you could save. These strategies, they could save you tens of thousands. They could possibly save you hundreds of thousands of dollars. So if you saved at least $250,000 for retirement, call us to schedule your free analysis. Remember, it's not what you make, it's what you keep. And as our time comes to an end, let me leave you with this. You do not retire in the amount of money sitting in your accounts, but rather you retire in the amount of stable and predictable income after tax that your portfolio generates. That's our show, and I hope you enjoyed it. I look forward to seeing you next week. Thanks for watching.
Jolly good show!